Hi, this is the Business Guy. Just a little stock market update for you. Morgan Stanley reported that the S&P 500 will fall sharply and join an ongoing bear market this year. So just wanted to report this to you and let you know what the experts are saying that it's going to happen in the future if you're a stock market investor. Then we'll talk about my analysis on the situation. They warn the S&P 500 is set to fall sharply and enter bear market territory this week as investors grapple with the rising interest rates and the global slowing growth. And if you appreciate this information, please like and subscribe. As you know, as all this money was just pumped into the market, and that's raised prices. Of course, we've got a supply issue that's caused a problem, as you know, and also we have a whole bunch of money, money pumped in, a whole bunch of money printing going on during the pandemic. And then, of course, with the supply choke, we're having issues with getting the adequate supply. And with a whole lot of money and not a lot of supply, the prices are going to naturally go up. On a Monday note, the investment bank strategist led by Michael J. Wilson said the S&P 500 appears to be joining the ongoing bear market ahead of the stacked week's earning reports from tech companies like Apple and Amazon, he said. And so this supply choke point here, and hopefully that will even out. It will even out eventually. I mean, in a free market society, supply steps up to meet demand. That's just the way it goes. So, though we're having the supply issues right now, I don't think this is going to last forever. It won't, and it's a temporary blip. But supply will eventually catch up to meet demand. Just a matter of when. And going on, it says, in short, the market has also been so picked over at this point, it's not clear where the next rotation lies, the analyst wrote. In our experience, when that happens, it usually means the overall index is about to fall sharply, with almost all stocks falling in unison. Okay, so hang on again for my analysis of this and what one's thinking should be during a bear market. If you had a few years under your belt like myself, you've been through this many times before. If you're on the younger end of the scale, then you may think the sky is falling. Don't worry, hang on. just invest in good, strong, cash-strong companies with increasing earnings. Remember that. We're gonna talk about that in a little bit. If the analysts are correct, the S&P 500 does enter bear market territory. It could mean a 20% drop from the index's early January record close of 4,793, and that would take the S&P 500 to 3,827, or around 9.5% below its Monday level. Quite a big drop on Tuesday. And in the past month alone, the S&P 500 has fallen nearly 7% as investors weigh the possibility of a faster pace of interest rate spikes from the Federal Reserve in the coming months. The Fed already raised rates by 0.25% in March. And as you know, mortgage rates are kind of eking up. That may affect the housing. It's going to affect housing prices because if that monthly payment's higher, housing is going to become less affordable. Last week, Fed Chair Jerome Powell said that a 0.5 percentage point hike could be in the cards in May. Morgan Stanley said the Fed policy likely could mean inflation has peaked, but cautioned that it may not be the best thing for public companies and economic growth. So when inflation hits, naturally we have to increase the Fed has to increase the interest rates to kind of cool the economy down a little bit so inflation doesn't just keep on going up like it did in the 70s, as I remember. Our gas lines, prices were just going up like crazy. I remember that when I was a kid. But he cautioned it may not be best, like I said, for the public companies' economic growth as well. The problem is that falling inflation comes with lower nominal GDP growth and therefore sales and earnings per share also. For many companies, it could be particularly painful if those declines in inflation are swift and sharp, the analyst wrote. The investment bank's bearish forecast comes after the International Monetary Fund, IMF, last forecast for the global growth from January's 4.4 figure to 3.6% last week, citing pressures from the ongoing Russia-Ukraine war, which has been another kick in the butt to our economy, as you know, and citing pressures from the ongoing war have and it says the World Bank proved to be even more pessimistic, cutting its global growth forecast on April 18th to just 3.2%, arguing that higher food and fuel costs will instigate a global economic slowdown. And then Morgan Stanley, an analyst who typically come up with fresh money buy list for investors, admitted they're really at a loss for new ideas. I mean, because so many of the stocks are just so high. They said investors stick with pharma and biotech companies due to the defensive attributes of this market. Morgan Stanley isn't the first investment bank to call for a bear market moving forward. Deutsche Bank said April is heading for a recession by 2023. So hear that? The U.S. is heading for a recession by 2023. Is what the forecast is. And Bank of America has warned that a recession shock could be ahead as the Fed acts to combat inflation. So let's go ahead and take a look at the iPad now, okay? Because there's a couple things I want to show you here. So here's what one wise investor told me when I was in my 20s, and it was a great lesson. He said that stocks are like a staircase, okay? And you have a man down here, okay, with a yo-yo in his hand, okay? And the yo-yo is going up and down and up and down, okay? So, and as the man walks up here and gets to these steps, and when he gets up to here, and the yo-yo is at its bottom, right? It's still higher than when the yo-yo was up at the top up here. And so, let me move my, jeez, there we go. So it's higher here than it was here. So what that's saying is there are fluctuations in the market that happen day to day, month to month, week to week. But the trend, if we look at the long-term history, we have to look at history, is like this. So rather than looking microscopically at these little things here, look macroscopically at this line. So the key thing, what he told me, and this is great advice, and really take this to heart, look at the man, not the yo-yo. So sure, there's this crazy stuff going on right now, massive crashing. That doesn't mean it's time to sell. No, the key thing is you want to invest in good companies. That's companies with plenty of cash and increasing earnings. That says earnings. And that's what you want to look for. Companies that are sustainable, that have a moat of protection, and so that they're going to be around. If you take a rocket ship, one of Elon Musk's rocket ship, and you live on the moon for 5 years, you know that company's probably still going to be around. I would guess Google will still be around. I guess Apple's going to be around. These sustainable companies, Walmart, is that going to be around? I don't see why not. Costco, is that going to be around? Probably so. So we want to get into companies that are sustainable, that have consistent earnings growth, and that are cash strong. If you do that, you can that's a shelter from the storm. Berkshire Hathaway stock is probably the best example of that. Warren Buffett's company. Even if he dies, I mean it's a great company, and he has great leadership in place to take his place when he kicks the bucket. And so anyway, that's what's happening in the market. Yes, things are going down recently, but keep your eye on the man and not the yo-yo in his hand. So please like and subscribe. I'd sure appreciate that. And this is the Business Guy.